invest just 10,000 every month for the next 40 years, you will get almost 10 crores. I have assumed a 12% return here. Look at the complete calculations. Isn't it amazing? Now you must be thinking that 10 crores is a big amount. Life will become comfortable with this. How would you feel if I said that this is a complete lie? This is a way to make a fool out of you. A way to make a fool? What do you mean? You won't get 10 crores? No, you won't. Then how much will I get? 9 crores? 8 crores? At the very least, I should get 7 crores, right? Henna? This is the exact trap you get caught in. You are trapped by showing a rosy picture. The truth is very different from this, which no one is telling you. I will tell you. Look, in this calculator, there is one very important thing that you missed. This 10 crores is not adjusted for inflation. You must be thinking, even if we adjust, how much difference will it make? I should still get 5 to 6 crores. Chalo, let's see how much difference it actually makes. You will get only 2 crores. You will get 10 crores, but its value will be equal to today's 2 crores. Felt the shock? And in this, we have assumed 6% inflation, which is an average number given by the government. For many things, inflation is much higher than this, like medical, school fees, etc. So there is a high chance that for you and me, the real inflation will be higher than this. Meaning, instead of 2 crores, you will get only 1.5 crores adjusted for real inflation. Invest after 40 years and even after that, get only 1.5 to 2 crores. You won't even be able to retire on that. Then what's the use of so much planning? What's the use of doing an SIP? Don't worry. I will tell you in this video how to turn this 2 crores into 10 crores. In this video, I will tell you 3 to 4 such methods with which you will be able to achieve your 10 crore target. The very first one is the most obvious, which is step up SIP. This is the most obvious one. Just a while ago, we saw that due to inflation, 10 crores will be reduced to just 2 crores in 40 years. Or to put it in other words, the value of money is decreasing by 6 to 7% every year. Now to counter this, why don't we increase our SIP by the same percentage every year? Normally, your salary also increase by 8 to 10% every year. Along with that, increase your SIP amount accordingly. Let me show you how this small change can have such a large impact on your portfolio. If we keep everything the same and just step up the SIP by 6% every year, then after 40 years, the final amount will become more than 21 crores. More than double. A small change made such a big difference to your final amount. If you step up by 10% every year, which is a bit aggressive, but if you do step up that much, then your final corpus will become 35 crores. With this much amount, you can rest assured that even after inflation, you will have a decent corpus. Now, this method was quite obvious, but these next methods are not that obvious. The second method is being an active SIP investor instead of a passive SIP investor and investing in smart SIPs. Now, what does this mean? A passive investor is someone who sets up an SIP once and then for years doesn't even know what's happening in the market or how the portfolio is performing. Here, if you become a little smart and stay updated with the market, I am not saying you should track the market day and night, but have a broad idea that the market crashed this week or it's doing well this week. By being active, you can gain a lot. Let me explain how. Let's say you are a passive SIP investor and your SIP date is fixed for the first of the month. So your money will be invested on the first. 3 days after your money is invested, the market crashes by 10%. Now common sense says that one should invest more money and take advantage of this temporary crash. But because you are a passive investor, you have no idea about this crash. So you won't be able to do anything here. SIPs also don't have any inbuilt intelligence to capture temporary downturn in the market. That's why SIPs can never grow as much as the market grows. But thankfully, there is a solution for this. This is called Smart SIP or Booster SIP. Let me explain in brief how this works. In this, when money is deducted from your account, it first gets invested in a debt fund. After this, AMCs have their own special algorithm that tells whether the market is at a temporary bottom or at a temporary high. If according to this formula, it seems that markets are at a bottom, then your money gets invested in an equity fund. If according to the formula, the market is at a top, then it waits for a while for the market to correct. I have explained this very briefly. In reality, it's a bit more complicated than this. By doing this, the returns are at least 2 to 3% better than a normal SIP. And many AMCs like ICICI, Kotak, etc. provide the special SIP. But to do this smart SIP, you will have to track the market a bit actively so that you are aware of the market downturns. If you have some lump sum amount, you can invest that extra as well in case of market downturns and earn extra. Related to this, there is one more method which is called buying the dip. Now, for this method also, you will have to actively track the stock market. Not like super actively, but like you should know broadly what's happening in the market. Let me tell you how this strategy works. Its simple meaning is that whenever the market corrects or crashes, then it makes sense to invest a certain lump sum amount in the market. Because everything is available cheaply. This is easy to say, but when the market is going in the red in front of you, at that time it takes courage to pump in more money. And for that, you will also have to keep a lump sum aside. But chalo, let's assume you have a lump sum amount and you have decided to invest. But still, how exactly will this strategy work? And how much return can you expect from this? Let's say you have 1 lakh lump sum to invest. So you can think of investing 25,000 on every 10% dip. For example, on 26 September, NIFT was at 26k. As of November 21st, NIFT came down to 23.3k, meaning an 11% correction. So I invested my 25% lump sum in the market. Now, when it corrects another 10% from here, meaning NIFT comes to the 21k level, then I will again put an additional 25% lump sum into the market. Now, this is not some fixed formula, but I will tell you my logic. If you go into history and look at stock market crashes, then historically, whenever a big crash comes, the markets correct on an average 30 to 50% from their high, with the average being 40%. It's not necessary that it will correct this much this time as well, but if it falls that much, I would want to capture the lows. If you also find this strategy right, you can follow it. Otherwise, you can follow any strategy. But the important bit is to invest a lump sum if and when the market crashes. You can easily get a lift of 2 to 5% on your overall portfolio depending on when the correction comes in your investment journey. If it comes right at the beginning and you invest decent lump sum, then the difference should be as high as 7 to 8%. Fourth is picking the right mutual funds. Yes, there are right and wrong mutual funds. These three funds have given an average return of 10 to 11% in the last 10 years, which is not bad. But there are some funds in the same category which have given significantly better returns. Let me show you these funds. These are the top 3 funds in the large cap category whose average return is 14.5 to 15%. This is almost 4 to 5% better than the worst performing funds. You must be thinking, क्या ही फर्क पड़ता है with this 3 to 4%? But let me show you a quick calculation of the difference it makes. With a 10,000 SIP, assuming you get a 10.5% return, you will get approximately 7.5 crores at the end of 40 years. This is not adjusted for inflation. But if the returns are 15% instead of 10.5%, then this amount will be more than 31 crores. This is more than 4x, so every percent counts. Now I understand not everyone has the knack to pick the right mutual funds, and picking the best funds over a 40-year horizon is very tough. There is also a problem here that some people will suggest funds to you by looking at past performance. But there is a very high probability that the funds performing well today will not perform well in the future, which is why we have simplified everything for you. We are a registered mutual fund distributor and we are officially opening our doors for you guys. We will manage your portfolios end to end. That means from picking the right funds to timely rebalancing, we will do everything for you. Usually these kind of services are reserved for HNIs, but not anymore. There is a free call booking link in the description. You can fill that. If you qualify, our team will get in touch with you and we will set up a call with you. Just a few disclaimers before you go ahead and fill that form. As SEBI registered distributors, we will only advise regular mutual funds. Matlab, we will earn a commission from investments. In return, we will do all the grunt work for you, including fund selection, rebalancing, making sure you stick to your goals, etc. Second, we are not onboarding a lot of customers at this stage. Our target is to onboard a few customers and serve them in the best way possible. For those few customers, we are expecting a minimum investment commitment. Could be either 4 to 5 lakhs lump sum or like 25 to 30k SIP. Below that, it won't make a lot of sense for us because we will put in a lot of efforts in serving you. Third, this form is open only for first 200 customers. After that, it will close. So my request is that if you are okay with these 3 disclaimers, only then fill the form. We will try our level best to simplify your wealth journey.